Options on stock, Part 6, protective put, covered call, naked option. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email, and our phone number. And I'd like to jump over to Excel and talk about a general comment about options. General term, long equals own. And own and long can mean one of two things. If you look below, long 100 shares in quotes means that you own the stock. Long 5 option positions means you own 5 options contracts. And this rule is true whether we own a put or a call. A big problem in options is knowing which terms I can apply consistently in the same way to both puts and calls, and which rules differ between put and call. In red, we say if you're short, that means you don't own, and there's a risk with not owning the underlying security. And the risk is you may need to make delivery to someone else, and there's high risk in that, as we'll find out with naked options in a minute. The risk is that you may have to buy something, and the price on that thing you need to buy can go up an unlimited amount. So the first position here is protective put. Remember, put means right to sell if you buy a put option. And the purpose of this protective put is to lock in a sales price on a stock that you own. And the reason you may want to do that is to protect the gain, to make sure you get the gain that you have on the stock. So here's our example. You own 100 shares of IBM. Now, in these types of test questions, normally the cost of the stock is not mentioned. It may be, but very often it's not. Your concern is, as I said up here, is that the price declines and that you sell it for much less than the current price. So what are some of your options? Well, one of them is you buy one contract controlling 100 shares of an IBM, that's the security, 50 put option at 2. We multiply 2 by 100 to get the out-of-pocket cost of $200. Now, in this case, you are the put holder or owner. And remember, when you own an option, you have a right to do something. When you own an option, you have a right to do something, and in this case, you've purchased the right to sell. You've locked in that sale price. If the stock price declines, you exercise the option. And if you exercise a put that you own, you end up selling shares at the strike price, exercise price of 50. Now, you have to deliver those shares to the person you sold them to, and you're going to make delivery to the buyer on the other side of the option contract of the shares that you already own. So let's look at a couple of examples, a little more detail. The value of the protective put position. If the market's at $50 or higher, well, you'd sell at the market. You'd let the put expire worthless. For example, if the market price is at 300, you could sell your stock at 300 and let the right to sell the stock at 50 expire worthless. The put seller, the person on the other side of the transaction, wants the put to expire worthless, so that put seller earns the premium. Another thing that's consistent in options is sellers of puts or calls. An option seller wants the option to expire worthless so they can keep the premium. If the market's below $50, below our strike price, you would exercise the option. Why? Because the exercise price of 50 is higher than the market, and I made it up and said, let's say the market's 35. If the market price is 35, you have a choice. Sell at the exercise price of 50 or sell at the market at 35. I think I'd rather use the option and sell at 50. So at $50 or higher market price, the protective put is going to be allowed to expire at a market price below 50. We're going to exercise the option and sell the stock. Please note this on the side. Strike price and exercise price mean the same thing. And market price differs from those two terms, strike price, exercise price. Okay? Keep that in mind. The second position is covered call, and the assumption here is, again, you own the underlying stock. that is the stock related to the option. So if it's an IBM option, you own IBM common stock. Again, the purpose is to lock in a sale price to protect the gain, but there's a difference here from the protective put, and that is we don't own or control the option. We are selling an option to someone else. So here's my example. You own 100 shares of IBM, and again, the cost of stock might not be mentioned. Your concern is that the price is going to go down and that you sell it for less than you can right now. In this case, we're going to sell an option. We're going to sell one contract controlling 100 shares for the security IBM. Strike price or exercise price equals 60. It's a call option, and we sell it at $300 or $300. In this case, we are the call option writer or seller. Again, two terms used interchangeably. We received a premium, and in exchange, we're obligated to do something. I've mentioned in class before on options that if you buy an option, you have a right. If you sell an option, you have an obligation. And in this case, you have an obligation to sell if the other party, the buyer, exercises. So what if the market goes to 60 or higher, and we need to think about what that option owner is going to do. That option owner or buyer is going to exercise the option. They control things. They're going to buy the stock from us at 60. So if the market price is at 80, that option buyer on the other side of the transaction is going to exercise the option, buy at 60, which is our strike price, and then they're going to turn around and sell it at the market at 80. So they don't have to pay 80 for the shares, they pay 60. The option seller, which is us in the cover call situation, must sell the stock at 60 at the exercise price to that option owner on the other side. And we make delivery of the shares we already own. Remember that we already own the securities and we're trying to protect the gain. So the result is on the covered call is that the option seller has a limited gain on those 100 shares. Why? Because if the market price is above the exercise price of 60, the option buyer is going to force me to sell the stock to them at the strike price of 60. So what's the value of the cover call position? Again, what we're rooting for as a call seller is that the option expires worthless. The market price is lower than 60. Let's say the market price is at 40. The option buyer, the person on the other side, is going to let the option expire worthless. They're going to go out in the market and buy at $40 because $40 is a lower price. We, as the option seller, are going to keep the premium. Why? Because the option expired and the contract's over. So the result is the option seller, that's us, has a limited gain on the 100 shares. Because if the market price is above the exercise price, we're forced to sell the stock. But what's our benefit as an option seller? Well, we get to earn the income, and specifically the premiums, from selling the option on the shares of IBM. The option seller keeps the premium if the option expires. And what we could do is do the same process as an option seller over and over again. Specifically, we sell an option. They typically have a life of several months. Keep the premium. The stock price doesn't move in the right direction for the options buyer. The option expires, and then we go out again on another contract and sell another option, and we get another premium. Last thing I wanted to talk about is naked option position, which is defined here in italics. When the option seller does not own the underlying stock. And this is the same scenario that we saw before in terms of the option. We sold an option. We got a premium. We're obligated to sell stock if the option buyer exercises. But again, there's a twist if it's a naked option position. If the buyer exercises, the seller must buy from the buyer, must sell from the buyer, and we've got to have stock to make delivery. Well, how high could we pay for the cost of that stock? Well, it could be infinite. So if I'm obligated to sell, my risk as a seller could be infinite if I have to go out and buy the stock to make delivery, because that stock can go up an unlimited amount. Now, in the real world, typically a brokerage firm is going to have a person have collateral to sell a naked option for one thing, and for another, they're going to force the investor to sell at a certain point to limit the loss, and that's going to be according to the new account form and documents you'll sign with your brokerage firm. That's sort of the reality of options. This is the end of part 6. If you'd like more information, more in-depth conversations that are not on the web, you'll find on our website a complete video options course that you can purchase. We also have a content library. All the Excel spreadsheets we use in YouTube and in our longer courses are available. Here's our YouTube channel, Ken Boyd STL. We have a complete list of videos on the website. For live one-on-one tutoring and chat sessions, stltest.net is the website. Here's our email and phone number. Thanks very much, and we'll see you next time.